Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
This is Jeff Barton. Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone and give us a call. We talk to you all day, all night, every week about loans. Loans that you're going to need, loans that you can't get. Now, there's a problem here in Southern California. And obviously, I want to say hi to KCAA, KMET, K-Tahoe, and all the great listeners who download the podcast each and every week. You can see us on YouTube. We're on themortgagevoice.com. Email is info@malibufunding.net. You can reach us in any number of ways. If you're listening to the show today and you are one of the people out there wondering how you can get a loan in order to get into this real estate market, there is some good news on the horizon about both the real estate market, mortgages, the supply and demand out there, as well as the supply of housing. Some of it is, I think, cyclical. What happens is when the market gets heated like it has been, probably for the past 4 years, and really heated up about 18 months ago for a year, everybody gets weary of it because what we've had is rising interest rates and we've had rising real estate prices. And when you have a dual threat like that against you, the homeowner, or somebody that wants to go out and buy a home, you're constantly at the push of, oh my gosh, if I don't do it now, I'm never going to get into the market. I can't raise my kids. They can't get into the good school system. What am I going to do? And so what happens is people get tired of that and they just check out of the market entirely. And that has begun to happen here in Southern California. So what does this mean? This means that prices actually have come down a couple of ticks from 6.2 to 6.1% in terms of year to date or year over year in terms of rising home prices. Now, that may not seem like a lot, but if it's one quarter, that's a trend. And we are basically approaching that kind of trend here in Southern California. Now, in other markets, this radio show is obviously in Nevada and Northern California, but let's just pick the Las Vegas, Nevada market. That particular market has been on fire for about 18 months, 2 years, and they've been seeing 12 to 16% year over year increase in real estate prices. Well, even there, what we've seen is a flattening or at least a downward tick in the progression of upward real estate prices. So if you're in the market, be patient. We're going to see in September and probably October. Now, what we've got is obviously a November 4th election around the country. So we're going to see a great deal of focus on that, both local media and national media, which takes the place of people's attention. If you're one of these people that needs to get into the real estate market prior to moving and prior to having your kids get into a new school system, you're already in your new house now, because most school systems across the U.S. start August 15th to August 22nd. That's true in Southern California. It's true in Nevada. It's true in Northern California and the Tahoe area, where this show is being broadcast as well. So you know that you've already picked out your place. Either you're buying now, have bought, or you're renting again this year. And renting prices, yes, that's true. Renting prices have really gone up. And I'm sorry about that. I wish we had more rentals for you. What we've seen in a lot of larger cities in downtown metropolitan areas is companies are building units to rent. There's a lot of money in that because the rents have gone up. I mean, we are now in probably the 7th or 8th year of expansion in terms of rental rolls and rent prices, both in the residential area and in the commercial area. So if you're looking at rents as a way by which, hey, look, I can't afford the down payment for a house purchase, the prices are too high, the mortgage interest rates are too high, yeah, you're looking at rentals. And unfortunately, as I said, rental prices have been going up as well. They are building more units, and they are trying to, there's a lot of companies around the country into the Los Angeles market, but certainly in the Nevada market, and they're buying 300, 400, 500 unit buildings. And some companies are trying to convert rental to condo, and that's a condo conversion that they're trying to do, but it's really not going to satisfy the demand in housing out there. But as I said at the top of the show, we are going to see a flattening of these prices. We are going to see a flattening of the increase in real estate prices year over year. And I think if we can get to 5% to 6% in that range, which I think is a normal progression of prices. Obviously, what we'd like to see is an equal number of buyers and sellers. That's not yet happened. But if the demand goes down and people get weary of this, as I said, you're out there, you're searching every weekend. And I know what it's like. It's summer and it's 110 degrees out. And you're trying to search with your realtor or on your own through Zillow or Realtor.com or Trujillo or Redfin or any number of the sites out there, trying to look on your own, contact people, get out there and look at the different housing. It's not easy. It's difficult, and you get hot, and you just don't want to do it. So the weariness that you might be feeling as a buyer is really across a lot of different spectrums in terms of what the buyers are looking for. So what we've seen a lot of reduction in prices. I think prices in general have been really sky high and pie high. They're looking for the highest, obviously, return on their money in terms of what they're trying to buy. So if you're out there right now and you're thinking, look, I'm out of the market, you're really not out of the market. What you are is in, the waiting zone. You got to wait. You got to be a little bit patient. You got to say, okay, after September, when really everybody is back at school, most people have bought who are buying. And in the local real estate markets, you're going to see probably an increase in properties because there'll be less buyers. There'll be weary buyers who aren't out in the market. So September, October, November might be some good time to get out there and look at properties. Now, if you go into a bidding situation on properties and you're looking, obviously, you need certain things to go in. If you're looking at September, October, November, where I think we're going to see not only a flattening of prices, but we've also seen mortgage rates flatten as well, meaning that based on what we see both in the economy and the upcoming elections, and usually this happens, by the way, mortgage interest rates really don't go up that much. The Federal Open Market Committee meeting that was last week had short-term interest rates stay the same. And of course, those interest rates nominally affect mortgage rates in the bond market, but they really affect your credit cards and they really affect your car loans and your short-term loans, anything in the payday lending. A lot of these are affected by the short-term interest rates, and the Fed held short-term interest rates where they are. So all of these things together are saying to me that a good time to go out there and look will be a time after September 1st, after Labor Day, when everybody is 100% not thinking about buying a house or selling a house. And by the way, sellers will begin to notice this 3 months after it happens. So if you get into a situation where you're bidding on a house and you think, based on what your realtor is telling you and based on your own knowledge of the marketplace, that this price for the house that they're asking is $100,000 overpriced, which is not uncommon in a lot of these areas in the Inland Empire. San Bernardino, Riverside, hi everybody out there. Thanks for listening to the show, and certainly up in the Tahoe area. If you think it's $100,000 overpriced, don't overbid. Bid under, because 3 months down the line, that same house you may be able to get even cheaper. Why? Because it takes sellers 3 months in order to realize that the market conditions have changed. I think they're changing now. If you go to Mortgage News Daily, where I get a lot of this information. Go to any real estate website that you can see that is not affiliated with a real estate company or a title company. Try to find something independent which can give you the information that I'm providing you here, and you will see the same thing I have. Looking down the road, we're seeing an election. People's focus is not going to be on selling their house. Looking down the road, we are seeing a trend of flattening mortgage interest rates as well as flattening real estate prices. You're going to get a better deal in 2 to 3 months than you are going to do today. Now, if you have to buy, I get it. You got to buy. You got to get out there. You got to get in the marketplace. You got to find out, what is the best strategy for today's market. And because it's early, no seller out there is going to want to be able to, is going to want to reduce price. They're just not going to do it. Anyway, I'm Jeff Barton. Thanks for listening to the show. I really appreciate it. We'll be right back, and this is The Mortgage Voice.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone and give us a call. We talk mortgages. We talk real estate. We talk what's happening in the San Bernardino, Riverside, and Tahoe areas of California and Nevada. Really appreciate all the people from KCAA, KMET, and K-Tahoe who do listen to the show. We are on Saturday and Sunday each and every week. And again, thanks very much for listening to the show. We try to bring great guests to the show. And in so doing, we once in a while stumble upon a couple of people who want to come on and talk about what's going on with their company. And it's a new affiliate for Malibu Funding. And again, thank you, Malibu Funding, for sponsoring this show. Their NMLS number is 79620. So I'm going to introduce a couple of people. I've known Maria Schroeder for a number of years. She used to be an AE at a different bank, a different lender. And, of course, Liz. Okay, I'm going to butcher this. Okay, Liz, help me out here, will you? How do you pronounce your last name? Is Schermerhorn? Schemmerhorn?
Yes, Liz Schermerhorn.
See, I got it. Perfect. I apologize for that. And that was just really, I actually knew how to pronounce your name. I just thought I'd bring you in with a little bit more of a laugh than a twist. So anyway, thank you very much for coming on the show. How are you both? And tell me a little bit about what's going on over at Royal Pacific.
We're doing great. We're expanding and growing rapidly. We're just got some awards that we're the biggest growing lender in California.
Now, you guys do non-QM, right? I mean, that's your niche?
Yes, we do everything, and we started non-QM about a year ago.
Yes.
Okay.
Yes, Jeff, Liz Schermerhorn here. I'm actually the director of non-QM, so
Great.
We do all the alternative lending. We're so excited to bring these products back after the collapse. They kind of disappeared, so all we had was conventional government VA lending and just a huge disparity in hard money, which you know what that looks like, high rates and high points.
Right.
Non-QM brings lower rates, lower pricing, and an alternative loan for those that don't have the down payment, that have the higher loan limits that aren't permitted per their county, that are self-employed entrepreneurs that can't document their income the traditional way, but will do it via bank statements. We're back to 10% down. For those of you that remember those days, the opportunity to buy 10% down to $1.5 million purchase price. Higher debt ratios to qualify, and longer terms than the old non-QM stuff. We offer 3-1s, 5-1s, and 7-1s, and the 30-year fixed product.
Hey, you know what? This is such a great market and such a great time for these type of products. I was talking off air to a client earlier in the day, and she was asking me, she said, well, this sounds like a lot like the old subprime days. I said, well, yes and no. I think it has some of the qualities of subprime, i.e. that more people can get loans, but because they're not government-backed, they are less dangerous because this isn't a Fannie or Freddie Mac purchase product. What do you guys do with the loans once you make the loans? Do you keep the loans? Do you sell the loans off?
I think most of this market is selling off to secondary markets.
Right.
There is a huge appetite today.
Yep.
In the last few years, it's kind of been rolling in. And so, yes, definitely secondary markets. Most of us are not portfolioing this type of paper.
Okay, and I think that what's important for me, and I think the listening audience, is the fact that there's an appetite for this type of product in the private sector, which is quite a bit different than what it was during the crash, which is why I think a lot of these programs are coming back. Do you agree?
Absolutely.
I agree with you. And just to know that underwriting's not just about an automated engine that
Right.
says yes or no, but that we're back to the story. And all of us as human beings have a story. There's credit blemishes.
Right.
There is a divorce. There is a bankruptcy, right? So
Right.
we're back to those days, and we're even back to 500 credit scores for those that need to reestablish.
Well, let's examine that for instance. There's a lot of reasons for a 500 FICO score, but being a conservative lender myself, I look at 500 FICO score and I see problems. What do you guys see?
we see somebody who went through a divorce or had a hardship, an isolated incident in their life, and, they've kind of reset themselves and need a chance to rebuild their life and credit. And
right.
Credit is a big piece of that.
No, I agree.
And what I see...
Go ahead.
What I see as a director, because I sit and structure most of these loans for all of our sales teams, what I see sometimes with the 500 score is not necessarily what you think. It's not
right.
somebody that doesn't have the ability to repay. It's, again, there's a story, something's happened. They, might have the opportunity with a ton of equity in their home to do a great debt consolidation loan and get back on track, right?
No, I agree.
Just because you have a score in the 500s doesn't mean that you don't have the ability to repay or that there is a bankruptcy or foreclosure. You could have 3 credit cards that are tapped, that are maxed, and you're paying 22% on that.
Right.
And we could change that. We can do refi cash outs to about 85% of the equity in your home.
And what is your specific niche? Now, there are a lot of companies that we have on the show that do non-QM products, and the way you're explaining how you guys might be different may be in the fact that you're building a story and it's manual underwriting. But is there another advantage to going with Royal Pacific?
I think there is. I think the teams here, non-QM is not new. So there's a lot of companies out there that are going, hey, this is a great new product.
Right.
This isn't new to us. Our underwriters have been around since the 90s and through 2000 before the collapse, and they've kept through, and they understand how to put these loans together and understand that today this isn't subprime. Non-QM requires reserves. We like to see compensating factors. We're not just out there doing, no down payment loans with no reserves. We want to protect these consumers and make sure that what happened in the past doesn't happen again.
Well, sure. These are all TRID compliant loans, right? These are not like non-owner occupied. These are all residential occupied loans, or are these something else?
So we do a little bit of everything at Royal Pacific.
I see.
Our non-QM products are segregated. We do owner-occ and second homes. And we do non-owners, all on single-family residential loans. There are some other products for the real estate investor that qualify just on the subject properties rents and things like that. Those are considered business purpose loans for the real estate investor or somebody that has a non-owner property.
Now,
those are great because a lot of those investors have had to resort to hard money loans, and we can give them better rates at lower costs.
Okay, rate. Let's talk rates here for a second. I know that rates are obviously at the heart of what we talk about when we're talking about loans. Is it much different than a conventional loan? I mean, where do your rates start, and how do you price them?
So with non-QM, rates are very different from the conventional and government world. You're going to see rates starting anywhere in the high 4s. Resonating, depending on the product, into the high 6s. On the non-owner products where you're just qualifying off rents or not at all, that could be in the rates in the 7s. But traditionally, you did ask me a question and I interrupted you.
No, that's okay. That's pretty good. Those rates are good.
It's great. And we're putting these clients in 7-1 arms at no extra cost. So a 3-1 and a 5-1 cost the same as a 7-1. We want our consumers in the longest term possible.
Of course.
We also offer a 30-year fixed.
Oh, that's excellent. Hey, could you guys shout out a phone number? Because this is Maria Schroeder and Liz Schurenmorn. Oh boy, I ruined that again. I so apologize. Anyway, they're both work over at Royal Pacific Funding talking about non-QM loans. Shout out a phone number for me, if you would, so that people can get a hold of you, ask you questions. I think the information is absolutely fabulous.
Absolutely. 949-878-7045.
And Liz Schermerhorn, 949-412-6164.
And I really appreciate you guys coming on the show. I know it was a little bit last minute, so sometime in the future, we'll get a little bit more prepared and have you guys come on and explain even more about what your company does. I really appreciate you coming on the show.
Oh, thank you.
Thank you, Jeff.
That's
We
on our.
enjoyed it.
Okay, thanks, Maria. Thanks, Liz. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's a telephone number. If you pick up the phone and give us a call, we can help you talk about your mortgage. Now, there is a lot going on in the mortgage industry, and we talked about it a little bit in the first segment about both the rates and about the availability of product. But if you're out there right now and you're wondering about, certain situations in certain climates, in certain conditions, let's say you're a seller, let's say you're a buyer, there's all kinds of different opportunities and ways to do business for real estate. With us now, I'm bringing to the show for the first time from E3 Enterprises in Nevada, John Sheldon. And John, how are you?
I'm good. Jeff, how are you doing today?
I'm great. Thank you very much. John and I met at and we've talked about the Outback. We've actually had John Lee on the show several times talking about that real estate investment network. And I met John there, a week, 10 days ago. And he had a couple of interesting things that he talked about. And John, I really appreciated you spending time with me there. You didn't know me from a hole in the wall, but I guess that's what those events are for, meeting people and getting a chance to expand your contact pool.
Absolutely. Always interested in talking real estate.
Yeah, always. And give us a little oversight, a little background of who you are and how long you've been in the business, just so I can warm up to a couple of questions.
Sure, no problem. Well, just generally speaking, I bought my first house in 1967, so I've been around like 51 years.
Right.
Didn't really get into it from a true investment standpoint until around 1983. But since 83, for the most part, I've been buying and selling property. I've had properties that I've held for several years. Never a huge volume, but and my focus basically has always been buying with no money down, no qualifying, going to a bank or anything. Basically buying subject to from sellers that are in distress and need to move their property and are willing to let me take over their existing note and then even carry back their equity. So kind of been my major strategy for the last 40 years or so.
Now, in Nevada, where you do most of your business, now you've lived in other places, obviously, but currently you're in Nevada. How does that strategy work there with the ascending real estate prices and the higher mortgage loans?
It's a lot tougher than it was. Obviously, the market here is as everybody I think knows, it's going through the roof. So anybody at all that's paying any kind of attention to the marketplace here realizes if they put their property on the MLS, ask the proper price for it, it's going to be sold in under 30 days and usually with multiple offers. And I don't mind paying full price for a property, but when I'm going to pay full price, all the more reason why I want to be able to get into that with no money down, no bank qualifying, and that I'll partner up with the seller. So I leave them involved in it and give them continuing appreciation, sometimes part of my cash flow if I'm going to cash flow the property. But there's still some opportunities out there. A lot of people upside down. Still,
yep.
I keep hearing 30%.
Wow, 30%, really?
Yeah, that's the number I hear, and again, don't quote me on that because it's information I'm hearing, and like John Lee would tell you, or a coach would tell you that's always information that's 6 months old and not necessarily valid information, but.
Well, no, there are, and especially, and I'm always surprised by this. I mean, we always talked about the shadow inventory after the crash, right? And so what happened to these properties? I don't know, but there is certainly an influx of new properties. I know on a national scale, we're not even close to 1.5% in terms of default rate, but there are pockets of people who are upside down, especially in a place like Las Vegas.
Sure. Well, I can tell you, just as an example, my own property in 2007. House I'm in appraised at $400,000. At the bottom of the collapse, mine was at about $150,000.
Oh wow!
Today I'm at about $280,000 or $285,000, and yet I've got a $315,000 mortgage. So I'm one of those people that's still roughly $30,000 upside down. Now that being said, if I was an investor, my own house is an ideal property that I would be looking for because I've got my house payments under $1,000 a month. The interest rate is only 2.58%, I think it is. So I could sell this place with a reasonable down payment, do a wrap on it, and probably make $1,000 a month in positive cash flow. And a lot of investors don't have a clue about how to do that. So
Right.
I talk to people all the time about, so why wouldn't you buy a property that's upside down? Well, it's upside down. They're $20,000, $30,000, $40,000 in the hole. Who cares? If you can positive cash flow it, if I can make $250 a month, forget about $1,000.
Right.
If I can make $250 a month in positive cash flow on a property, I could care less what the balance is as opposed to the value.
Right.
No,
that's
those are
absolutely
some of the deals
true.
that are still out there, but again, they're harder to find, and then trying to get sellers to understand the benefits to them of selling to somebody with those kind of circumstances. They either concerned about their name still being on the loan,
Right.
or they just don't understand that. Like say, in my case, I'll give them a percentage of the appreciation on the back end. I usually will sell 5 years down the road.
Right.
So typically, I'll give somebody 50% of the appreciation 5 years from now when I turn around and sell the property. So essentially, they're my partner
Right.
in the transaction, and yet I become responsible for the payments and renting the place out and taking care of it, and so on and so forth. So, and I've got some deals that I've done that way. Again, I currently have a couple of properties that I bought with those kind of transactions.
Do you, in the Outback, in the real estate investment network that you and I both belong to, do you find that these types of groups are helpful for people who are new into the business, or is it really people who are looking for, I guess, when you come to a group like that, usually you have a property that you wanted to do, or you have something in mind. It's just not you're coming in cold. Are there sharks there looking to attach themselves to the newbies, or is this a place whereby you think that you can learn how to do this and meet good people?
It depends on the particular group you're going to. Now, the Outback is one of the best I've ever come across.
Right.
And you're right. I've lived in Arizona. I was in California for 11 years.
Right.
Spent 7 years down in Arizona. I've been in Nevada for 34 years. The Outback is just one of those exceptional groups. I mean, know the mantra, they invest in man and land in that order.
Mm-hmm.
So they're basically an educational club. They're always willing to work with people. They connect people up with money, with transactions. I mean, almost anything you can think of, they're always there ready to help, as is maybe not all of the group, because they have over 2,000 members, but
Right.
There's a large number of the people just like me. I spend as much, if not more, time helping people, and I typically, at the moment at least, I don't charge, so I keep considering becoming an actual coach and start charging people, but up until
Right.
this point, I help people at no cost. I might partner with somebody on a transaction and split a transaction with them, but for the most part, I have people call me, and I'll give them verbal instructions or even written instructions on how to structure an offer to somebody where, again, no money down.
Right, of course.
I'm going to assume your loan. I want you to carry back, that type of an offer.
Hey, shout
work
out
with
your
people all
phone
the
number
time.
if you don't mind, now that you're talking about, working with people.
Mm-hmm.
Do you have a phone number that you could give people?
Oh, sure. My cell phone is 702-250-7841. And I, at least at the moment, unless my phone starts ringing off the hook, I basically answer my phone at all times of the day or night. I'm essentially available 7 days a week.
Now, we have about 2 minutes left. Tell us a little bit about E3 Enterprises in Nevada and what that's all about as well.
It's just an entity that I formed. Actually, I've been using that name for probably 3 years, but I just recently formed an LLC to make it a legal entity. And primarily because I do most of my transactions now using a beneficiary-directed inter vivos revocable trust.
Right.
So rather than me have my name go onto a contract, I will buy in the name of my LLC
Right.
and put it in a trust, and the LLC becomes a beneficiary of my trust. So just an added layer of protection. But
I
do
think,
the same thing with that, except I've made a few loans to people. I mean, almost anything related to the real estate business. I don't have a lot of money, but I get somebody that needs $15,000 or $20,000 to do a transaction and just quick turnaround. A lot of times I'm in a position where I can loan out a small amount.
Right.
And, make a few bucks on the transaction for people.
Well, you have such a wealth of knowledge. I mean, in that last bit that you just kind of went over very quickly, I mean, we spent probably 45 minutes talking about how to place properties in the proper vehicle so if you're lending or as a lender on a property with somebody, that in a vehicle that is serviceable rather than going directly to the buyer if the buyer defaults. That was really interesting to me, and how that would work and protect both buyer and seller. And next time you come on the show, I really want to get into that a bit more, if you don't mind.
I gotta say, yeah, if I've got another minute or two, let me throw that out because.
Well, I've only got about 20 seconds, so.
Okay.
I'm sorry.
So that's all right. I'll make it as short as I can. And
okay.
So by using a revocable inter-vivos trust, you can prevent having to foreclose on somebody. You can put an occupant in there on like a rent-own, but it's not a true rent-own. So if they default, you evict them. You're protected because, again, it's in a trust.
Right.
And you're just the director of that trust where you actually deed the property to the trustee. So the trustee owns it, so you've got asset protection. You don't have to worry about foreclosure.
Right.
You don't have to worry about violating the due-on-sale clause. If you've got a mortgage, a bank cannot foreclose on a property that's being held in an inter-vivos, irrevocable inter-vivos trust. The bank cannot exercise due-on-sale clause. And your tenant can actually take the tax write-offs based on IRS regulations. Your tenant can be given the tax write-offs as though they had true ownership, and yet they're truly just a tenant, so they can be evicted in whatever your state's eviction laws are, as opposed to having to file a foreclosure action and maybe fight for a year and a half, 2 years to get your property back. So,
well, great. Again, I'm glad you quickly brought it up. Next time I want to get into it and question each and every step along the way, because I think it's really valuable information for people who are in the business that we're in. Thank you very much for coming on the show. Thanks, John. And that's John Sheldon from E3 Enterprises. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's the telephone number. Pick up the phone and give us a call. We talk mortgages, we talk real estate, we talk everything that's happening to you and your dreams of owning something here in Southern California. When it's 110 degrees out, there's no humidity, or there's a lot of humidity, and you're just dying trying to get into something. We always bring to the show terrific people, and Meredith Schlosser, who has been on the show before, is another example of a terrific professional who is really hot today, because where she is, it's 97 in the shade. Meredith, how are you?
I'm good. I'm actually in Manhattan, so I'm barely surviving the heat, but I'm good. Happy to be here as well. So.
Okay, so summer vacation, it's always a time where people are out of town, and in our business, it seems to be that it's never a good time to take a vacation. How do you find time to do that?
I barely do. I mean,
right.
This is just a very this is actually very spontaneous. Being a mom of two kids, this happened to be just a spontaneous last-minute trip. So
right.
My roots are in New York, so I had to come back actually and visit my 93-year-old grandmother.
Oh, that's awesome. No, yeah. That's awesome. Is she in Manhattan? Is she out in the boroughs?
She's actually in Long Island, yeah.
Oh, yeah. Very good. No, I lived in New York, as you well know, and you and I both had a real estate transaction that we did a number of years ago, and I always was impressed by the fact that you were not only professional, but nice at the same time. How do you deal with difficult clients? How do you deal with difficult agents?
I think that I'm more a therapist these days than I am anything else. I should probably get a degree in psychology.
Right.
I actually, to be perfectly honest, I don't let things get to me as much as I used to when I started off. I used to really take things home, take things personally, go to sleep upset or happy and, ride the emotions of a roller coaster. Now it's, who am I dealing with? If people appreciate me for what I'm doing, great. If they don't and they, talk badly to me or mean to me or disrespectful to me, then you really have to look at them and be like, why are they acting like that? And I honestly, at this point in my life, I'm mature enough where I feel sorry for them. So, I get up every day with a mission, and my mission is to help the clients. I'm either helping buy or helping them sell and get some deals in escrow, close some things, and be a service to people and enjoy it while I'm doing it, and make people enjoy, themselves as well, and make it not, make it painless.
Yeah, I think
it's such a stressful situation.
It is. Of course it is. And especially in a market where you've got rising interest rates. So obviously the cost of the loan is going to be more. And obviously the cost of the real estate keeps going up. So people are stressed because, one, they can't get in the market, or if they can, they're worried about their finances. So, yeah, there is a lot of stress out there, especially in the summertime when it's really hot. We've been talking a little bit about that today, just how to stay cool, how to, do showings when it's 110 degrees outside. I mean, how do you handle the heat when it's like that?
I mean, it's funny, coming from New York, as you know, with 4 seasons. I mean, you get up, there's no snow days, right? I mean, we're not in school anymore. It's the same thing with LA. I mean, you get up, you do your thing. It's hot. I always bring waters for people. I always make sure when I'm showing properties, that the properties are air conditioned. And I joke around, I call us the Meredith Uber service, because I always have myself and my assistant in the car with the clients. We drive them around. We make it easy for them. So, it's one of those things, accommodating people, making it easy. Where we are in LA, especially where I live on the west side near the ocean,
right?
It's not as bad.
That's true. That's true.
So it's actually quite enjoyable. It's okay to have a couple of hot days because it's not really that terrible. So.
Tell me about Compass Real Estate, because I know that they're kind of a new kid on the block. What's it like working there, and why did you make the switch?
Well, we actually moved our whole team over there right in February, and I love it. I mean, the CEO, Robert Refkin, is extremely involved. He's hands-on. He wants to get to know his agents. And, the thing is, what I said about being an agent, helping my clients and being that go-to and making it painless, that's how he makes it for his agents. And he wants to make the experience better for the agents. He wants to make the company better for the agents. And it's a full-service company. There's so much support. There's so much staff. They throw parties. They do fun things. They have get-togethers. I mean, they appreciate the people that are giving into their business, and they want to give back to the people who are giving to them, right? So it's different than all of these other corporate companies. I won't name names of where we've been before. It's just a little more family-oriented. The culture's humble. There's just a different vibe. It's an energetic, it's a young vibe. There's always people in the office. It's the energy when you walk in there is phenomenal. And, I've always noticed that in LA, not as much in New York when I worked for a couple of different companies in New York. Like, people were never really at the office. It was like when you go in, for me, I like to get in. I like to get motivated by other people. I mean, our office in Beverly Hills, there's always people in there, 6 a.m. to 9 p.m. or whatever it is. There's always energy, and that motivates me.
Yes, it does. Yep, I agree. So. Okay, let's get down to brass tacks here. What's the real estate market like on the west side?
It's crazy. It's hectic. It's busy. It's competitive. A majority of what I do, I live in Playa Vista, so that is a majority of my business. I mean, we are, with Google coming in October, we're seeing a huge demand, a huge influx of people. Rents are record high.
Yep.
Properties I'm putting on the market are getting in multiples of the first open house. From Playa Vista, Westchester, Marina del Rey, Santa Monica, same thing. I mean, my main price points are anywhere from 1 to 3.5, 4-ish million, and then I do higher and lower. But it's competitive. I mean, in my eyes, there hasn't been any slowdown. I know people keep talking about it. I know
they are
in the higher end. But for what my bread and butter is, and for what I do and my clientele, I'm not seeing any. And representing buyers, making sure that we stick out, we represent ourselves as a good package. I'm persistent, and I really paint the picture for the other agent or directly to that owner seller. But it's very competitive. You need to have a leg up for sure.
Now, when you present offers, do you present them in person? Do you write a letter? How do you give your clients a leg up? Because obviously your personality and the way you show care to the clients is certainly something of benefit to the client. But when representing them in a negotiation, in presenting offers, how do you give them an advantage by using you and what you do?
Yeah, I mean, I think it's just nonstop. I think that I don't, I give them advice. I make them, I have the mortgage broker call. I call, if maybe I find out if there's somebody I know the owner by any chance. I mean, LA is a big town, but it's a small town.
Yeah, you're right. You're right.
I dig into who the owner is. I joke with people, but I've had cookies delivered. We've had flowers delivered. We've had people bring things to the owner's office. I mean, I know it sounds cheesy, it sounds tacky, it sounds kiss-assy, but it's, at the end of the day, I've had buyers, go to the person's house and drop off flowers or whatever it may be. But most importantly, a really heartfelt letter from the buyer to the seller, unless it's a developer. Obviously, we know they don't really care about that.
No,
but,
no, it's bottom line, right? Exactly.
They definitely don't care. But it's just that extra step, and it's really communicating with that other agent. Like, what does the client want? How can we give it to them? Unless they're trying to be sneaky or shady and double end the deal and kick you out, which we all know that happens in LA.
Sure does.
But it's just persistence, and it's really fighting for them, and being a no bullshit agent, and I tell clients, I paint the picture to be, hey, listen, this property is, let's say, $1.1 million. We know it's competitive. You can't go in there asking $1.2 million and then nickeling and diming them on inspections. And I reiterate that to the agent. And I say, listen, they're not going to do this. They're going to do their inspections. You're not going to be sorry that you picked them. And I've proven myself time and time again that I don't represent those nitpicky clients. And I don't put up with that because I want to close the deal just as much as the buyers and the other agent want to.
Of course, we're all in it to get paid, but at the same time, having that kind of approach really demonstrates, I think, both to all parties, the buyer especially, that, it's a people business and you got to be there for the people in order to make it work. And I think that's probably what your advantage is.
Exactly. I don't go to sleep at night until all my clients have their questions answered.
Right.
Until I feel good about the day, until I feel like I've helped people get to where they are. Because, as much as I have 2 kids, I don't like to be 24/7, but there's so many emotions. I deal with a lot of first-time buyers. It's nerve-wracking. I remember buying my first property. I wish my agent was similar to me because, she didn't explain anything to me, ever.
No, trust me, just sign here. I hate that kind of agent. Listen, we're up against the clock. Yeah. Can you tell the customers or the folks out there your telephone number in case they need a great agent?
Sure, 310-923-5811.
And this is
923-5811.
Thank you, Meredith. This is Meredith Schlosser from Compass. Is it Compass Real Estate? Compass Really?
Compass.
Just Compass.
In Beverly Hills.
Yes, it is. Okay, thank you very much, and I really appreciate you coming on the show again.
Thank you so much for having me.
Of course, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's the telephone number. Pick up the phone, give us a call. You can email us, info@malibufunding.net. We are here. I want to answer questions about either rates in today's climate, what's happening, what's going to happen in rates in the future. I think we're going to see 2 more rate hikes this year from the Fed, which will obviously not directly affect your mortgage. We've seen bond market prices actually stabilize and come down a bit this week. So let's get right to the rates. And this, of course, is from Matthew Graham over at Mortgage News Daily. And we kind of look at this each and every week that he puts out. Really appreciate it. Let's see. So 30-year fixed rate at 4.625%. And by the way, that's a pretty low rate when you consider it. I just paid off probably in March a 30-year loan that I had at 5.125%. We're still below that, and I thought that was a smoking rate when I got it. So if you're out there and you're thinking, oh my gosh, I can't afford it anymore, well, yeah, that's something to take a look at. And certainly qualifying income is not easy, but adding a friend, a family member, somebody to the loan might be a solution for you to get the income you need in order to qualify for the mortgage that you need. VA, FHA loans, 4.25% to 4.5%. Now, we had seen both the 30-year fix and the FHA VA loans actually come down a little bit this week, and that's because we have had some interesting effects in the bond market. We've had some cooling in real estate prices, and as a result of the bond market, which has, the yield has actually gone down a little bit. So that means that the mortgage interest rates are also going to go down because when there's more demand in the bond market, you're going to see the real estate, the mortgage rates go down a little bit. Our 15-year fixed is at 4.125%, which is pretty good. I mean, although the spread between that and the FHA loans is not that much. Remember now, the FHA loans bear with it insurance. So if you're going to add in the insurance and what you pay for the insurance on top of the rate that you're paying for the loan, you probably get a truer interest rate of another quarter point. So that's something to bear in mind when you're looking at different options for loans. The ARM products are great. I like the ARM products. The reason is because I, like a lot of the guests on the show today, being in the real estate industry, understand that if you're an investor, you're not going to be in a property 30 years or 15 years or even 10 years. So if you get into a 5 or a 7-1 ARM, which is an adjustable rate mortgage after the initial fixed rate period, you're probably already going to be out of the house, or you're cash flowing at the future raised rate once it goes into the adjustable period. Anyway, the 5-1 ARM today, 3.75 to 4.25%, and that's pretty good. If you're an investor right now and you're looking at a property and you can secure a loan at 3.75%, well, that's significant, because it means that not being at 4.75%, 4.625 to 4.75%, which is a 30-year conventional loan. That's what the 30-year conventional loan is today. If the difference between the two is, a couple $100 on your monthly payment on $100,000, so you have a $300,000 loan, it's going to be $600-700 less at the 5-1 ARM. That's a very good savings, especially if you're in an initial period of construction or you're wanting to flip a house. Any dollar that you save in the market on a monthly basis is another dollar you can put forward into the fixing of the house or into the investment of the property. So I think overall, the short-term 5-1 year, 7-1 year, 10-1 ARMs are really good investments, really good deals. A couple other things of note in the News to Use section, Jan Swanson. Black Knight every month comes out, or every quarter comes out. Actually, it's every week, but every month, and this is the report we're seeing now. We talk about Black Knight. They're a compiler of information and statistics. They talk about the home price increases are slowing and the affordability stabilizes. Two things. Increase in property values has probably slowed because of the demand. We talked about that in the earlier segment. There's a lot of fatigue in the market right now. It's summer, it's hot, and if prices have been going up as they've been going up, as I talked about, in the last 4 or 5 years, and rates have been going up on your loan, people get tired, they beg off, they get out of the market for a while. So what happens is less demand means obviously that the prices can't continue to rise as they rise. Now, in certain sections, in certain areas of the country, let's just talk about the areas that we've had on the show today. West Side Los Angeles, prices are still moving higher. Why? Because everybody wants to live at the beach. You're 110 in San Bernardino Riverside today. Guess what? It's 75 at the beach, 80 degrees tops. So the difference between the 30 to 40 degrees from the Inland Empire and the beach is the same demand on properties. People want to be where it's cooler than in the winter where it's warmer, and certainly there's much more demand on beachfront property here in Southern California than there is in desert property in San Bernardino Riverside, all the way up 15 out towards the 210. Any of those freeways where you're going to have a lot more opportunity, because I believe because of the heat, because of the fatigue in the market, and because what we have now is stabilizing prices, you're going to have opportunities come, as I said earlier, in September, October, and November to be able to afford a house and buy a house. We're going to have real estate prices stabilizing more, and we're going to have the mortgage market stabilize more, so that you're not going to get 6 to 7% next year in the real estate increases, but you're probably going to get 5%. So if we have a downward turn in the rise of real estate prices over the year, this means that the affordability index, i.e., how much does my dollar afford me in today's market? That means that if we have a flattening or a stabilization of home prices and mortgage prices, your dollar goes farther rather than going less, because both of those indicators going up. And so as that happens, again, October, November, even December, you're going to see some opportunities in the market. And you're going to see them pretty readily, I think, in some of the areas. Now, one interesting thing, we had a guy on the show, John Sheldon. He talked a little bit about the pockets in Las Vegas, Nevada, that people are still upside down in their houses. Now you're thinking, how can that be? We've had such a rise in prices since 2010. Well, believe it or not, even in places, San Bernardino, Riverside, the surrounding communities, you will find pockets of homes that are still upside down. If we are at or near the peak of what we were in 2007, 2008, and I think we are in Rancho, certainly, and we are in Covina, and we are in a lot of the communities up and down the 15 and the 10, but some areas we are not. Paris and Hemet and Hesperia and some of the areas there, we still have properties that are upside down in value. And finding those properties, you can go and find noticeofdefault.com or some of the other websites that you can find these properties if you're an investor and if you want to try to get into that world. Let's get into a couple other things before we end the show. Freddie and Fannie ending strong this quarter. Now, we have a call for, although I don't think we're going to find it, Jerome Powell at the Fed and over at CFPB, there are, and especially in Congress from the Democratic side, calls for straightening out of Fannie and Freddie. It's never going to happen. It's not going to happen now. We're in an election cycle, so if people want reform in the housing sector, what I read today was people are probably waiting and wishing for something that's never going to happen. We're not going to see the federal government get out of receivership. There's just too much money coming in from Freddie and Fannie, and that's what the article here by Jan Swanson says. They're making good money, great money, billions of dollars each and every month that get swept into Treasury. And it's a little bit complex. We've gone into it on previous shows. As a matter of fact, because of that, we have, if there is a downturn, we have the possibility of another bailout of Freddie and Fannie. But if they were allowed to keep the particular money that they make on a monthly or a quarterly basis, obviously we wouldn't have that. But Treasury sweeps the profits out each and every month, and that is really one of the disadvantages of federal ownership of Freddie and Fannie. But at the same time, we're not going to see any kind of reform. So nibbling around the edges, maybe, yes, but as a matter of fact, we are up against it. I'm Jeff Barton, your voice in the mortgage industry. Sorry about that. I wanted to continue, but I'm looking at the clock and we're at 53:54. I'm Jeff Barton. Really appreciate you listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.